looking forward to having an interesting and fun session today. As always, it is the beginning of September. That always means back to school for everybody, and we're looking forward to just getting into the process of how markets work a little bit today. And the way they work, to me and probably to most of you, is through the auction process. I want to thank Dan again. Dan, I'll get you for this one of these days. And
Another 3 weeks, and then it's my turn.
What's that?
Another 3 weeks, and it'll be my day.
Okay, and I will make sure and let everybody know. All right, so let's take a look. I always have to introduce ourselves. For those of you that don't know us, my name is John Hoagland. I'm the senior performance coach here at Topstep. This joke might be getting a little bit stale, but I much prefer middle-aged performance coach. But I do have 38 years of industry experience, not all of them necessarily actively trading. I have been trading for probably close to 30 of those years. Traded on the floor of the Chicago Mercantile Exchange for well over 20 years. In 2009, I decided it was time to migrate to screen trading, as we all are working and trading on now is screen trading. It took me a while to unlearn some of the things that I was looking at in the pit, and kind of relearn the way to look at markets on screen. It was a full year before I took a live trade on screen. But in 2011, I met Michael Patak and Eddie and Melissa, and they were just getting started with Topstep, and I fell in love with the idea because we weren't going to be able to start the way I started. Nobody was going to be able to do that anymore, and that was to get a job on the trading floor as a runner and work your way up. Dan, I know that you had that opportunity as well to kind of work your way up, and I'd like to introduce Dan, my birthday teller here, to introduce himself. Dan, please.
Hey everybody, I'm Dan Hodgman. I'm also one of the performance coaches here as well. I was a 30-year bond option trader. That's kind of where I started and grew up. I was very fortunate. My father was a 30-year options trader. He owned a few different prop firms, so I kind of had no choice but to get into the industry. I started out as a kid, just being a runner, checking trades, and then kind of worked my way up. Started hedging for a few different options traders until I was able to start kind of managing my own accounts. I was down on the floor for quite a few years, and then I decided to kind of step away. I went and joined the United States Marine Corps. During that time, that's when I really got focused on futures. It was something I could do as a retail trader and not have to have large backing. And so I started managing my own futures accounts. When I got out of the Marine Corps, it was back to the prop firms. That's when I started looking at treasury yield spreads, working with natural gas teams, focused really up in the offices, working with a bunch of team trading as well. And then I left that in 2017. I was going to take myself a little vacation, and next thing you know, about a month later, I was over here at Topstep Trader, working with everyone, John and Michael and the whole team. So it's been a very fun and exciting 3.5 years so far, and I look forward to sitting down and chatting with everyone today.
All right, thanks, Dan. Yeah, it's been it's been what, 3 years since you started here. Boy, that time went fast. I think
Almost, I'm going up to 4 here on the first of the year.
Holy cow! Wow, that has gone fast. It must mean we're having a good time.
Right.
Awesome. All right. So let's dive into the auction process. I'm seeing a lot of familiar names here and a lot of people who've been around with me for quite a while, and welcome. Glad to have you here. Some of you may have heard some of this. We're going to get a little bit deeper than I think maybe we have in the past as far as the auction process is concerned. I see Ute's asking if Eddie is still around. Yes, Eddie is still around. He's with us. Yep, he works with people just kind of coming into the program to tell them about the program, and he's a good friend and a good man to have around. And Ute, will make sure we say hello to him. Dan, you've got a fan here. Jose is currently in the Army. Just kind of looking at some of the questions and comments here. So All right, now what is the auction process? Well, what is really the purpose of these numbers, of these markets? The real purpose of these markets is to facilitate trade. They are to create opportunities for those at risk in these markets to hedge their positions. In other words, to protect themselves from price swings. it, and the market's job is to facilitate their ability to do so. The market's job to facilitate trade is basically to find the level or the area of balance or value where two-sided trade can ensue. In other words, when a market is in balance and it's kind of trading back and forth between two known levels, that is a market that is doing a good job probably of facilitating trade, because both sides aren't that far apart as far as what they're looking for as far as value or too expensive. Excuse me.
You all
Or
right
too,
there?
yes, yeah, I'm all right there. Sorry about that. So a market is going to auction price higher until that price is viewed as too expensive for those that are willing to continue to buy it. And that upside auction will then come to an end, and a new auction will begin, and the price will then auction lower until price is viewed as too low, and that downside auction will then end, and a new auction to the upside will begin. Everybody that is in the auction process is a participant in that auction process, whether we're a big trader or a small trader. So the auction process
Hey, John,
occurs.
real quick, I hate to cut you off here, but just
No,
touching
not at
on
all.
that last slide you had there. I think for me, I'm a big visual person. I think if someone were to go look at the equities over the last 2.5 weeks, give or take, we saw the market. Let's take S&Ps for an example, balancing out really well around that 33.80 price for about 3 or 4 days. I think that's a prime example of where the auction process found really nice balance. We finally kind of broke above a little bit higher. That auction process started to work its way to the upside. That was giving us that auction process of, hey, this value, this is worth probably a little bit more, until about 3 or 4 days ago when we started seeing things sell off. So I think just when you're thinking about a visual perspective of the auction process, equities have really kind of defined all three of these over the last 2.5 weeks, give or take.
Well, then we can show right here.
Well, look at you. You got it all.
Yeah, here's the S&Ps. Now, basically, we've got a market that is moving consistently higher over time. This is a longer term auction process where all participants are continuing to push price higher and higher. Now, Dan is talking about this level up here, I think is pretty much what you were talking about, right?
I started talking from the balance perspective. We started to see the market balance essentially where we're at right now, that 33.80 to 33.90 range, about 2.5 weeks ago.
Here,
Yes, so that was that kind of balance area. Then we saw it, the auction process moving higher until about 3 or 4 days ago when the break started.
right. So it's a great example of a longer term upside auction abruptly ending and a new downside auction beginning. Thanks, Dan.
Absolutely.
So we saw basically a good example of when price got too expensive, buyers backed off and sellers came in. And this is how the auction process works, is it's in multiple time frames. In other words, a trend higher on a short time frame trade, on a short time frame chart, might just be kind of a rotation in a longer time frame trend in the opposite direction. Okay, so if you're looking at a 5-minute chart and you're looking at a trend that may look like it's a big trend to the downside, look at a higher time frame. You may just be looking at a pullback or a short time frame auction to the downside that's part of a bigger time frame auction in the opposite direction. I'm starting to think that this downside auction here might end up being just that. We've had some consistent movement to the upside. Our upside auction has ceased for the time being. We've got a volatile move to the downside, which opportunities or opposite auctions do tend to be somewhat vicious. But now we've seen the auction to the downside, at least for the time being, and a new upside auction begin as of today. The longer time frame is usually going to win. It's stronger money, it's bigger players, and their auction process is in a completely different time frame than those of us, those of the speculators. Now I've got a little bit of a chart here that says this is basically a look at the auction process in a range bound marketplace. The market comes down lower, puts in a base here, puts in a high here. Well, we could kind of expect that high off of this here. So when the market is rotational, we're in a two-sided auction. Prices getting too expensive here, too cheap here, too expensive here, too cheap here, too expensive here, and too cheap there. This is a range-bound market, and it does offer some pretty good opportunities in the fact that we've got some pretty stable or well-known areas where previous rejection of the auction process was occurring on the high side. We also have some pretty good solid kind of ends of the downside auctions here. So when the market becomes directional like this, it kind of shows you in a longer time frame where the bigger participants are. If I'm going to be a producer, let's say we're looking at corn on this particular chart. If I'm a producer of corn and I'm using these markets to hedge myself or to lock in good prices for my corn, I'm going to be looking at this area up here as, okay, this is where the upside auctions seem to be ceasing. I'm going to be looking for opportunities to sell corn every time we get up here. If I am a user, let's say I'm General Mills and I'm going to need a lot of corn to make my cornflakes or my frosted flakes. Price gets down to this level, I might be looking at the opportunity to buy corn at cheap levels down around this area. But who is in the middle? Does the producer and the user, do they ever meet in the marketplace? Dan, can you tell me?
Say that again, John. You cut out for me.
Do the producers and the users of products ever truly meet in the marketplace?
No.
No, they do not. The producers are always looking to sell high. These are the longer time frame producers of the products that we're trading, whether it's crude oil, maybe it's corn, maybe it's gold, maybe it's a stock index that is long stocks and is looking to hedge in a stock index future. They're always looking to sell high. The users are always looking to buy low, whether it's General Mills trying to buy corn for their cornflakes. Maybe it's Ralston Purina trying to buy soybean meal so that they can continue to create the animal feeds that they use and sell. Everybody between the producer and the user is a speculator, and those speculators, I put this little slide together with different fonts and different types of of letters here to kind of give you an example. I don't know how good it is of the different types of speculators. There's longer term speculators, there's short term speculators, there's speculators that scalp. They're in and out 10, 20, 100 times a day. There's speculators who are looking for opportunities that may last a week. Some are looking for opportunities that last a day. But every time a producer sells something or a user buys something, it's from one of the speculators. Speculators do not have to buy all the way up here from the producers and then hold those positions all the way down here to the user. They can use the auction process, which is usually long and arduous between the producer side and the user side, to cut losses. If I just bought corn from a producer, chances are I paid too high. I can get out of it here. I can sell it to another speculator here, who can sell it to another speculator here, who can sell it to another speculator here. All of this activity is part of the auction process, but it's the producers and the users that really create the opportunity, or at least the bigger opportunities that many of our speculators aren't even looking for. And the ones that are going to be the ones that are going to take the bigger rides.
Well said, John. Very well
Thank,
said.
thank you. So we just saw an example of a range bound market where short time frame auctions bounce price back and forth between two relatively known levels. This would be a downside auction or continuation auction where price continues to push lower and lower, seeking the level where sellers are no longer willing to sell it at that price, and buyers come in and take over and end the downside auction, and then the new upside auction ensues. Every one of us as a futures trader, everybody who has ever traded futures has had the experience of, okay, the market is auctioning lower, but I'm going to pick the bottom. So we see the market come down here. We get a little bit of relief. The market comes and goes against us more. So we think, well, if I liked it up here, I'll love it here. So we buy it here and it kind of goes right through us. Our auction to the downside is presenting as very healthy, but we're ignoring that because we have to be right. So the price continues to push against us and against us and against us till finally we get this little bottom here and we say, aha, I've picked the bottom. Here it is. I liked it here, loved it here. I really love it here. We get a little bit of relief, but our longer term auction is not over yet. It takes us down to here where we say, okay, I hope this is going to be the bottom because I can't take much more of this heat. Liked it here, liked it more here, decided I needed to put more on here. I put more on here, and now we finally got a little consolidation. The auction is pandering. The auctioneer is saying, I don't know, is this auction down over? Is it over? Or did we change directions? No, apparently not. We're going to take it to the point where you're going to have to get out of all of these longs that you've accumulated all the way down there. And we used to have a name for this in the trading pit. And we saw people do it to the point where they were no longer able to continue to work. They were no longer able to play. They had lost their accounts on days like this when we fight the auction process. You like it here, you put more on here, you put more on here, you put more on here. Everybody standing around you at that point is looking at each other going, he's got a moron trade on.
You know, John, I think it really is. You think about it, and if anyone's ever listened to us, whether it's here or in a coach's playbook or on the market forecast or recap, we can't stress enough. Our job is to go with that trend. That term, trend is your friend. It sounds crazy, but these auctions can become steamrollers and they move really, really fast and they can run you over really quickly. If you get behind that steamroller, as I like to say, and you follow with it, that's where you're going to start to find the opportunity. Once that steamroller slows down, as you guys can see here at the bottom, that's when you can start to turn things around. And that's where your opportunity is. But you really have to wait. Prime example was stuff last night, like these equities, when they gapped open lower, everyone started at peeling off positions because chances are 2, 3 days in a row of 4, 5, 6% down moves, say in the NASDAQ, expectations of margin calls and people having to get out of their positions is what's going to lead to this auction process turning around. But you have to wait for it to tell you it is finally done before you go ahead and catch that knife.
Excellent. And, in large part, that's probably a lot of what seemed to happen in the S&Ps for the last few sessions.
Mm-hmm.
Here's a look at it. I mean, you can almost see what it looks like, just like that chart that we were just looking at. Okay, here's our high. The market takes off to the downside. Well, we're going to try and buy it here. Well, that doesn't work. We try and buy it here. Well, that doesn't work. We try and buy it here. Well, here's where we puke out of it, and that's when the auction turns direction. So one of the most important things that I can tell anybody in futures trading, whether you're new or whether you're experienced at it, is do not fight a directional market. We've seen a lot of traders just think they're going to pick the bottom or pick the top in a directional market. I've seen very few people gifted enough to do so with enough regularity to survive. So there's certain parts of the auction process that we want to make sure that we're all aware of. Price being probably, believe it or not, one of the least important features of the auction process. All price is a collective perception of value according to all of the market participants at this very moment. When you look at price, that is the value of the product right now, not now, but right now, but not now. Price is absolutely nothing but the advertising mechanism of the market. We said the auction process goes higher until it's viewed as too expensive and buyers won't buy it anymore. They're gonna back off. It surely will attract sellers. You'll get a swift move in the opposite direction. The upside move is now over and a downside auction is now in place. It's where value is that is most important. People focus on price. It's okay if it works for you, but price is really only the advertising mechanism of the market. Then there's time, which is a big part of the auction process. Time marks acceptance of current value. As price spends a long time in a specific price zone, it's indicating the acceptance of value. The areas where price does not spend a lot of time are areas of excess or rejection. Price gets too cheap. Sellers won't sell it anymore. It attracts buyers. The downside auction is now over and a new upside auction begins. The best trades are not going to be available for you for very long. One of the parts that aggravates me with 23-hour markets is quite often the auction process ends overnight. Here's a perfect example of it. Okay, this is 3,300, this black line right here. Those of you who follow the weekly kickoff numbers, the weekly kickoff levels, know that this is an area that I'm looking for acceptance below or rejection at. What I would say is rejection is last night, whatever time this was, just after, actually, I think it was as the market reopened last night after the close. We tested this weekly kickoff level. Sellers completely vacated. Buyers took over. We did not have very long to get into a position in this area, in this excess area. The downside auction, at least for now, is over, and the new upside auction began. Okay, so if you are looking to trade in areas where the market has spent a lot of time or expended a lot of volume, you may be looking in the wrong spots. You want to look for areas of previous rejection or excess. That low last night, I'm viewing as excess of price getting too cheap or rejection of price getting too cheap. There's excess, it got too cheap. The rejection moves price higher. Volume is another major part of the auction process. Volume actually measures the force of the auction process. A market that is continuously pricing higher and value moving higher on higher volume indicates a healthy auction that is likely to continue in its current direction. But as an auction comes to an end, volume should slow. In other words, as we continue to move a market higher and higher, if we can't maintain volume, or if volume begins to fall off, we start drying up volume at higher prices, we can expect a probable change in direction sometime soon. And there's another part to this in the open interest. A lot of traders do not understand or even think about the importance of open interest. What open interest is, it is the absolute total number of commitments or contracts outstanding in a futures contract or in an options contract. The thing about futures is it's a zero-sum game. When I buy a one lot and I open that position and somebody that I buy it from opens a new short, it increases open interest only by one. When you see the open interest in the S&P is at 1,600,000, that's 1,600,000 longs and 1,600,000 shorts. Okay, that is the total number of contracts outstanding. Well, what does it take to create a contract? It takes two parts, one against the other, both of them expected to facilitate that contract. Okay, so in a market that is consistently, let's say, for example, moving higher over time and higher volume, if we continue to see open interest increasing in that direction, that tells me that there's more money coming into the long side on higher volume, on higher value, on higher prices. That's a healthy auction. Now, there are those that are always going to argue with me, well, if open interest is equal number of longs and shorts, what's the difference if there's more or less of them? And the difference is open interest is in infinite time frames. Your longer time frame producers and users are creating open interest, not only just the speculators. So if we have open interest continuing moving price in a particular direction, that means there's still enough interest in short, medium, and long time frame to continue to put money into the market in that upside direction. Yes, they are creating shorts as well, but because of the difference in the time frames, the motivations, the risk tolerances, and the length of the length of time that different participants are going to be in these markets, we actually can sort of pit time frame against time frame by keeping an eye on open interest. If we see longer time frame buyers coming into a market for a long period of time, we can assume that they're not buying it from other long time frame traders. We can assume that they're buying it from short and medium time frame speculators. The more the buyers, the longer time frame buyers continue to get the medium and short time frame traders short, the more likely it is at some point they're going to snap and they're going to go from sellers to buyers, and you're going to get a big push to the upside, kind of similar to what we saw perhaps in the S&Ps the end of last week. Everybody was waiting for that melt up, for the last of the shorts and the last of the new weaker longs to get into the market before the market could turn direction. Does it ring a bell to anybody? I know it does to me. So while this is useful for a longer term awareness of market state, when used with volume, it can give a good indication of how money is moving into and out of the market. And even if you only get 3 or 4 wonderful trading opportunities in a year just for watching open interest, it's worth it. Doesn't take that much. Watch volume and open interest and direction. When open interest and volume start to fall off in an upside auction, watch out. You may want to start thinking about selling strength in that market until something changes. So monitoring that auction process is, again, a longer view of the health of the direction in a market. For a day trader, understanding the auction process and viewing it consistently can keep you on the right side of the market and keep you from being or staying away from fighting with the longer time frame, with the bigger traders. Okay, now when a market is in range, there's probably some pretty solid viewable, visible levels of, let's call them resistance, let's call them support. When a market is out of balance, when a market is directional, when it is trending, that's really when you're going to want to be paying attention to the volume and open interest, because you're going to see the market get your direct competitors too long or too short, and almost on a daily basis. If you can recognize that and pit yourself against your direct competitors by using the elements of the auction process, you're once in a while, you're going to be able to catch your direct competitors the wrong way, and you're going to be able to see it, and you're not going to be one of the lemmings that's jumping off the ledge. You're going to be smarter than that. You're going to be going the other direction, because a lot of the best trades are really kind of contrary to the biggest, to the most recent market activity, and many of them are opposite of what you're hearing and seeing from the talking heads on TV. By the time the public finds out about it, it's over. So when you think about it, as day traders, a large percentage of our direct competitors are going to lose. Most of them are not considering anything with regard to the auction process, volume, open interest, value, and time. You can be smarter than they are, and you can do the opposite of the dumb things and the fear-based things that most retail traders do. Then you're giving yourself a really good chance of actually having a better outcome. We know most day traders are going to lose. If you're doing what they're doing, you're going to lose. If you're smarter than that, and I believe most of you are, and I think just about anybody can succeed to some degree in trading futures if we can just give up our fears or understand our fears and how we can use them to perform better, to be better than our direct competitors. The longer time frame traders, they have the money to move markets. They have bigger decisions to make, and their motivations are much greater, much bigger than ours. You know, they're fund managers and they're bank owners, and their idea of risk is far different than ours. But if we can catch our direct competitors and learn how to use their fears against them, we're going to put ourselves in a hopefully a much better situation. All right, I've got quite a few questions here I'm going to take a look at here. I do want to say thank you for joining us, and we're going to have lots more, hopefully great webinars coming up here. Hopefully that you found this one useful. This one, to me, is one of the most important things that traders can kind of get their head wrapped around. Is these markets aren't here just for me to buy and sell at will and try and make money. These markets are far deeper than most of us think that they are. These markets are here to help producers and users protect themselves against price swings. And for our opportunity to participate, we have the ability, we have the possibility, but not the absolute right to profit. It's up to us. It is a complete meritocracy. Whatever we can take out of these markets, we can take out of these markets. So, and I, again, believe that most people have the ability to take at least some degree of success out of these markets if they would only give up a couple of things. Their inability to change their response to duress and fear, and their inability to accept the changes that trading successfully in futures can bring. Everybody that comes into trading believes that they've come here to change something. They want a greater income. They want to change their life. They want to change their career. They want to add a little bit more income to their current income. Whatever it is, there's a reason that they're here. And until we can get used to the fact that this could actually happen, we put things in our own way to keep us from succeeding. Don't let your lack of knowledge of the auction process cause that for you. All right, so let's take a quick look here. I'm going to start at the top. A lot of happy birthdays. Thank you all very much. I see some good familiar faces here, some new faces. Great to see everybody, and great to see the new faces as well. Blessings, Joshua. Yes, 21 again, Howard. Yeah. Sean, I'm hoping that you got your sound right. I'm pretty sure everybody can hear. Come for the lesson, stay for the dad jokes. Thank you, Tanya. Ute, yes, I'll be making sure and tell Eddie you said hello. All right, Sean's good now. Excellent. Um, Dan Jose, I said this earlier, is currently in the Army. Too much champagne, maybe. Well, I don't know. I haven't had any champagne yet, although I did have a couple of double shots of espresso. And maybe you can tell maybe I'm talking too much. I'm not sure. Okay, Jose has left, but here's his question. This is my first Webby ever with you guys, webinar, I'm assuming, and opened a TST account yesterday. What is the purpose of this webinar? It was, Jose, if you didn't leave, to discuss the auction process and how important it is to understand how auctions work in your everyday ability to recognize opportunities in the marketplace. Kevin says this is a great info for the beginner like myself, and I mean a true beginner. Blank slate here, and I'm taking all of this in. Well, I'm very happy, Kevin, that you were here for it. And stick around. Wednesdays I do a group coaching session. It's on the website. Let me know if you want to get into that, and as you have questions, and we're more than happy to try and help you get a better and better understanding. Robin, yes, this is being recorded. Norman, we trade leveraged instruments with strict loss parameters. The value of the S&P or the NQ is what the last trade was agreed to. How do you utilize this in time frame that is likely minutes long? Okay, this is a great question, Norman. If you are able to recognize in a longer time frame where we are in the auction process, where in the continuum of the auction we are in. Are we at the beginning of an auction to the upside, or are we in the beginning, in the middle of an auction, or does it appear that we're nearing the end of an auction? If I'm looking at the beginning of an auction to the upside, but I'm only looking at short time frame trades, you can bet your bottom dollar, Norman, that I will be looking to buy weaknesses. If I see that the longer time frame auction process is to the upside and it appears healthy, even if I'm a short time frame trader, I'm looking to try and buy weaknesses on any time frame chart that I'm looking at. Why? Because it's giving me a leg up just from the very beginning. If the auction process is healthy to the upside, look to buy weaknesses in whatever time frame you're in. Okay. What profile product are you using, and what time frame is best for
Profile, John.
setting? Thank you. That was difficult to say. This product that I was looking at using here, this is the TS Trader or the Tradeovate platform. I'm looking at it in 30 minutes time frame, and I'm also looking at it, if I can here, I'm also looking at it through the lens of volume profile. So this is the volume profile here. They haven't put today's on there yet, but here's the open. Oh, I screwed that up. All right, here's the open. Yep, I did screw that up. All right, let's try that again. So here we go. Here's the open, the 830 bar. Okay, now basically we're closed, so I'm just gonna keep that one to the left. There's our volume profile for today. I also like to use market profile, but I don't have that available for us to take a look at just yet, but we will. We will very soon. But profiles for me, a market profile is always, TPOs are 30 minutes long. It's just the way I learned. Yes, you can shorten or lengthen the time of the TPO. As long as you do it consistently, I'm okay with that. What site is best to work the open interest numbers? Great question. Hang on. I'm gonna go here. Here is the CME bulletin. Let me see if I can put it in the chat here. All right, there it is to all entire audience. That is the URL to this document. This document will give you, here's the crude oil, okay? Tuesday, September 8th, this is the final. There is a preliminary number that comes out. This one comes out about 8 o'clock in the morning, maybe 9 o'clock. This is the October contract. This is settlement, net price, net change, volume, and open interest for just the front, the front month. In crude oil, there is so much open interest all the way for about 3 or 4 years. I focus on the overall open interest and the overall volume for my decision making as to how good the auction process is doing. So here I'm going to go into the equities. Here says preliminary. If I restore, now it's the final, Tuesday, September 8th, S&Ps, settlement price, open interest. We lost 14,000 in open interest on that move to the downside yesterday. Does that sound like a healthy auction process when we're losing open interest in a particular direction? Not really. I think that move to the downside offer high, for at least for now, has been somewhat hollow, but this is the site where I get my open interest, volume, settlement, all of that information. But again, it's not going to be, it's available in the morning, but it will say preliminary, and there will likely be some changes in open interest between the preliminary and the final. Okay. Where can I see the auction process? I'm confused about that. Is it the same? Where can I see the auction process? I'm confused about that. Is it the same as same as time, open interest, volume, and where do I find the open interest in the charts? Okay, we just showed you that, Jane, but the auction is quite visible on the charts. You see a price moving higher over time. You can assume that there is an auction to the upside underway. It's being able to understand the health of that auction through using volume and open interest and time that gives us that opportunity. Now, Jane, I'm not saying that any of this is easy. All of this is something that takes time to get your head wrapped around and to really find a way to learn to believe a lot of what we see in trading. We tend not to believe. We even tend not to believe that we're capable of putting together a winning strategy. So we never even give it a shot. So, Jane, come to the weekly coaching meetings. I can tell you more and more about the auction process and even suggestions on how to organize the information in and around the auction process. And again, sometimes it may not be for 2 or 3 months where you're going to see something in open interest and volume that's really going to speak to you and that's going to truly suggest a change in direction.
And John, just to add on that there, Jane, something to consider, the auction process is the market itself. It's just a way of understanding why that market is moving in directions. So I think if you think about it in that perspective, that it is the market itself going up and down, are buyers and sellers determining the price of a product.
Excellent. Yeah, you think about it. I mean, the charts are merely a picture of what's going on in the auction process. So, Dan, you're absolutely right. I mean, the auction process is the market.
Right. And I think, like, for perspective too, when we talk about auction process, think of just any auction you'd see on television, or you go to buy a painting. The chart is kind of showing, okay, here's where the price is starting. So say they come in and they're asking, the starting bid is 10,000 for a painting, and no one comes in at 10,000, and then the first offer is 3,000. Okay, there's the start of our charts. We went from 10,000 to 3,000. And then buyers start to come in, and over time that the value of that painting is going to go lower, and that's going to change the direction of the auction, and then it's going to go higher, changing the direction of the auction once again.
Thank you, Dan.
Yep.
Samsung, hey John, can you go into how you arrive at your weekly kickoff levels that we get from you for the upcoming week? How do you derive them? How should we utilize them? Thank you. Well, Sam, this is a question I get more and more, and I can tell you they're kind of an amalgam of um, technical analysis, information that I glean from the profiles, a little bit of math, and a little bit of vision. So, and the little bit of math is something that I keep proprietary to myself. But even if I was able to sit down and kind of explain to you how I come to those levels, you would come to them in a different way, and probably in a bit of a different spot. And I hope that you find them useful and important in your trading. I mean, we can see in the S&Ps, our weekly kickoff low here, 3,300, actually ended up being supportive for us. It's only Wednesday, but Monday, Tuesday night, it hit that level and it changed the auction from lower to higher. Don't know if it's going to stay that way, but you know, it's difficult to explain how I come up with those levels. And part of it is something that I just don't share with other traders.
I
Sorry about it.
say I say just keep tuning into the market forecast and recap, and we're going to continue to kind of talk about those levels that we think are going to come into play. But like John said, it's tough to explain how we come up with some certain levels, but if you tune in, and we're going to talk about why they're important to us.
Thank you. And boy, we've got a lot of thoughts, a lot of questions here. John Manning, thanks for the time and information. John says he left, but he says I'm his hero. I guess you'll have to trust me on that. But John, hopefully you saw the information on how to monitor open interest and how to find open interest. Steve, hopefully the same. Please comment on the latest recent market drop. Why did the market start falling on this particular day? There was no news before the fall. It just needed it. Honestly,
Doesn't always need news. Sometimes the market has to take that deep breath.
yeah, I mean, you know, looking at this drives me crazy, but looking at, you know, we had here, I'm going to give you a little trade secret here, folks. Here we had recent highs and a whole bunch of new highs, if we can get back there. Come on, come on, come on. Give me some more. Okay, since you're going to fight with me. Okay, here it is. This was I believe, a new all-time high that occurred in the overnight session. We were unable to take out that high in the current day session on that day. Again, here, a new all-time high, we were unable to take it out. The market does not like to leave new all-time highs or recent highs left in the overnight session. Here again, we have an overnight high. Actually, this is the one that we actually finally took out. This was an overnight high. The market opened, looked lower, and we finally had our blow off. Everybody's been looking for, when's the blow off going to come, our upside blow off. Well, this was the day. So when we had our blow off and we were unable to open above it, we were unable to even put in a new overnight high above the all-time high in this session. These were both signals or indications that, okay, this auction process is in trouble. We had basically an emotional blow off move to the upside. We were unable to take it out in the overnight. We were unable to open inside that late spike on this particular day. That kind of signaled, okay, maybe we finally got everybody too long in short time frame in order to continue this move to the upside. So we had a pretty good down day, another good down day. The auction changed from upside to downside. It seems to have ceased last night at weekly kickoff low, or very darn close to it. So now, do we change from selling strength instead of buying weakness like we were doing? Well, how was the volume on this move to the downside? Did we increase or did we decrease open interest? We decreased open interest all the way down here. This was not new selling coming in. This was long liquidation. This was late to the party, weak money longs taking their lickings, and possibly some medium or longer time frame traders taking some profits off the table on this move to the downside. If we've taken out enough of the longs or perhaps even gotten short in short time frame here, this might end up being a low for a period of time. I hope that makes sense. So yeah, it doesn't have to be a reason for the market to drop, although it does help because typically our equities, if there is no bad news, they just continue to grind higher and grind higher. Thank you, Gary, Shibi, and Angel. My pleasure, Andrew. Thank you, Virendra. Good, Leonard. I'm glad you found it interesting. Okay, we've got just a couple of minutes left here. I just want to say thank you to everybody. Dan, thank you very much for joining us and helping out on this webinar. Nothing in this world would be the same without you, Dan.
Thank you, John. And just some final words. First off, John, again, happy birthday. And everyone listening, this will be posted up on our YouTube page, hopefully by tomorrow. So if you didn't get to catch all of it, we'll get it up there so everyone can tune in. And these will be going every Wednesday for the next few weeks. So we got 3 more of these every Wednesday at 3 p.m. Central Time. And then lastly, make sure you do check out John's weekly group coaching. You can find that right on the performance coaching page at topsteptrader.com. Up in the top right corner, you click the about, and there's performance coaching there. If you scroll to the bottom, there's an option to join the free weekly coaching. So make sure you guys check that out. John goes into a lot of detail on open interest and the auction process on a weekly basis. So I highly recommend tuning in there. And again, John, happy birthday.
Thank you, Dan, and thanks to all of you. Get some rest tonight. Be ready for another exciting trading day tomorrow. Maybe we'll see you all in the market forecast tomorrow morning, as well as the market recap tomorrow afternoon.
Absolutely.
Until then, get out there and trade well. Dan, thank you. Thanks to all of you.
Thanks, John.